calculating all these, messy tables, is better to you just amortize according to straight line, because difference is just 0.001 and that is negligible difference. So how you're going to account for the straight line method? It's just simple one, that the case of the discount, suppose Southwest Financial Vice President is considering issuing 9% bonds at 96149. And there is straight line amortization for the bonds. So the semi-annual payments, so 9%, 100,000 multiplied by 6 by 12, answer is 4,500. Simple, right? So what is the difference and how much is the discount? Discount is 3851, right? So this is for 5 years. 5 years mean there are going to be 10 payments. So it means the interest expense is going to be increased by 3851. Now entry would be interest expense $4,885 to they pay 4,500 to discount bonds payable, which is 385. So you see a smooth figure every year to decrease from the discount on bonds payable. So you see here interest expense to bonds, discount on bonds payable to cash. That's it, right? Now question arises, should we retire bonds before maturity? Can we? Answer, can be, if all parties agree, because this is the contract. If the parties are agreed, the borrowers and the borrowee, the company and the bondholders, they are agreed that okay, we should retire the bond right now, you can retire it. Or if you make any kind of clause, callable feature, bonds can be callable or can be buyback at pre-arranged price, then you can also mature the bond before its maturity, right? So reasons to pay off the bonds early: number one, can relieve high interest payments. You predicted that you would be paying 10% coupon, and that would be based on your analysis for 5 years whatsoever. But what happened? Turned out the market situation is totally changed. Right now it is 10%, but for the next 5 years it is 2%, 1%, 3%, 1%. So it means you are paying very high interest rate. So you can call your bondholders, you can say that okay, we will be paying you 50% more payments on your principal. Please send us the bonds payable and we are going to retire it. That's it. So that we can just borrow through the market at lower interest rate, right? And what is callable feature? So you say that callable feature is that bond is callable at the price whatsoever in the, for example, quoted as 101 or 104. So everybody is going to be paid at 104, which is $1,040, $40 extra on every bond holder or 1 unit of bond holder, if there is a gain or there is a loss. For example, the company, they issued the bond for a project and they say that we are going to use your money in the project. And what happened? The project failed miserably in 2 years. So they fear that after this one, we are no more liable for this kind of stuff. Or if our project is completed in 2 years, but we hope that we will complete it in 5 years, So you receive the loan for 5 years, but your project is completed for uh, in 2 years. So you can call the bonds and you can pay back the money. Or if you have a loss, so it's better to retire all the loans rather than just paying them interest for 3 more years and pay back the principal, because paying back the principal, which is a huge amount, is also risky because at that time we may not have that much liquidity, right? If we are having a loss right now, maybe at that time we don't have much money, and then these bondholders can go to the court and call our company to liquidate. In that case, we may lose our company as well. So in that case, you try to pay them according to callable feature the money as soon as possible according to pre-arranged price, and this price is going to be accepted by both company and the bondholders. This is pre-arranged before issuing. You write it down that okay, this is callable after 2 years, but for 2 years we won't you know call it at any cost, right? So whatever in the interest rate, whether interest rate of the market decreased, the decrease to 2% or 1%, but we will pay you 10% for 2 years, and after that we can callable at any time, after 1 month, after 1 year, after 2 years of the callable period. Okay, so that is the feature which allows the companies to retire the bonds early before maturity. So we have one more illustration here, which we are retiring before the maturity, and it's basically valuation and entries are pretty much easier. So I'm just going to read that one and go for solution. You are required to pause the video and please read the question thoroughly and try to attempt by yourself, and at the end match the answer. So here we go. So the company has 300 million debenture bonds outstanding. Assume that the unamortized discount is 30 million, right? It means the 300 million debentures are issued at discount, and discount is 30 million. So assume that the bonds are callable at 101, right? Bonds must be callable at 101. If the market price of the bond is 99, will Southwest call the bond at 101 or purchase them for 99 in the open market? So the market price is better choice. Why? Because if they call, they have to pay 101. If they don't call, they can just buy back their loan from the market at 99. So this is just for your information. So retiring the bond at 99 result in a loss of $27 million. So how we can compute that? They have mentioned here. So par value of the bond is 300 million. So 300,000 is the discount. So total bond value is right now 270 million. So if we buy back from the market at 99, right? It means 19.99 multiplied by 300 million. So we have to pay $297 million to buy back all the bonds from the market. So the difference is $27 million loss. We are paying 27 million more to our bond value on the balance sheet, right? So which one is better? Either to pay 0.101, which is 1.01 multiplied by 300, which is, please calculate that. 300 multiplied by 1.01, it is 303, which is also huge, right? Your bond value is 270, and if you buy back, you have to pay 303, and your loss would be Bond value right now is 270. Your loss would be 33 million. So where you have a minimum or the less loss or minimum loss is to buy from the market, which is 27 million loss. So it's better to buy back from the market rather exercise the callable option, because in callable option you have to pay $33 million extra amount, right? So these are some small features of the bonds. Bonds can also be convertible into stocks and shares. Yes, if you add some features, you say that after 2 years, the bonds can be convertible into 2 or 3 stocks, or 4 stocks, or 5 stocks, or 100 stocks, whatsoever, right? So bondholders can exchange bonds for stocks. So benefits is that the guaranteed receipts of principal per interest on the bond, because it can be convertible. It means you can refuse that or you can accept that, right? But there is also a potential for gain on the stock as well. For example, Southwell has convertible notes payable of 100 million, and note holders convert notes into 4 million shares of Southwest common stock, which means one par value of the common stock. So into 4 million, so 101 million is converted into 4 million. So simple. So how much paid in capital? We'll talk about this paid in capital in our treatment of accounting for the stocks, common stock, we'll talk about there. But just to understand the entry is that when we decrease our liability, decrease in liability means debit. It means 100 million liability we are decreasing liability debit, and we are issuing $4 million par value, 1. So 4 million multiplied by 1, answer is 4 million. So we are issuing $4 million worth of common stock. So convertible notes payable to common stock, and the difference is called excess of power, which is 96 million. So this is how it is convertible. So we have successfully completed our long-term liability. So the important parts here is to understand the valuation. So not valuation, the recording or the entries of issuing the stock at par, at discount, at premium. So that is the most important stuff for you guys to master at that one. And that's all for our lecture. If you have any question, you can ask. Misha, any question? Arone, Ping Ping, Minsu, Sipade.
Sir, do we have an assignment for this lecture?
Yes, we have this assignment 8. I would be uploading it on our Blackboard discussion forum as well, and also on our WeChat group.
Okay, because I'm a little bit confused. I don't know about what, but I think when I do the assignment,
I request you to please watch our today's lecture video as well. So because I know that this concept these are really hard concepts. So I just request you to please go through our YouTube links. Please watch over there as well. And even if you don't understand that one, please do write us in our WeChat group so that we can just sort it out and we can have a revision of this concept as well. Okay, guys? So I would be uploading this lecture, this book chapter, and the YouTube links on our WeChat groups. Please do visit that one. Okay? Take care. And see you next time in our next class. Bye-bye.
See you, sir.
Thank you.